Welcome back to the deep dive. You expect the usual volatility coming out of the holidays, maybe a predictable January rally or retreat.
Right.
But the intelligence briefing we received this morning suggests we're starting 2026 in a fundamentally different place. The narrative is no longer about speculation.
That's the key shift. We are transitioning into a phase we're calling sovereign and industrial hardening.
Okay.
The focus is less on whether the asset class will survive and much more on how it's now being utilized by the largest global players. We're talking nation-states, infrastructure giants, and multi-billion-dollar corporate treasuries.
So we've moved past the novelty phase and into the deployment phase where utility is crystallizing at the geopolitical and global financial levels.
Exactly. And the briefing makes it so clear that we're seeing this massive strategic bifurcation in how this is happening.
A bifurcation? How so?
Well, on one side, you have the Western markets, which are mostly concerned with regulated custody, ETF flows, managing compliance costs. It's slow and heavy. But then on the other side, you have jurisdictions in the global south, or those under sanction, and they are accelerating the weaponization and integration of digital assets into statecraft. They're using it offensively or defensively, right now.
This sounds like the easy money phase is definitively over. The rules are changing under high pressure.
They absolutely are. It means the success metrics for 2026 won't be about Bitcoin's price high, but about its infrastructural penetration and its function as a tool of strategic policy.
Okay, let's unpack this. If we're talking about strategic deployment, we have to start with the most consequential geopolitical development in the briefing.
Get it on.
Iran's Ministry of Defense Export Center, or MINDEX. This feels like a true crossing of the Rubicon.
It's a profound structural shift. This ties cryptocurrency directly to state defense and the global arms trade.
And the intelligence confirms this.
It confirms that Iran is now formally integrating digital currencies right into the military export supply chain. They are openly offering advanced military hardware.
What kind of hardware are we talking about?
Ballistic missiles, drones, even large naval components, all in exchange for digital currencies.
And this is, well, it's not happening under the table.
Right.
The reporting suggests this Mindex platform is essentially a direct barter protocol.
That's the most alarming part. It's a sophisticated public mechanism designed explicitly to circumvent the strangulation of their access to SWIFT and the international banking system.
So it's a parallel clearing system.
Yes. The platform, which is hosted on infrastructure already targeted by Western sanctions, explicitly signals that sanction circumvention via crypto is not a rogue operation. It is formalized state policy.
This is the open solicitation of crypto for kinetic weaponry.
It raises the stakes immensely.
So what's the expected fallout? Because if this is a platform for missile proliferation funded by crypto, the regulatory response from the West is going to be swift and probably draconian in Q1.
The anticipated blowback from the Financial Action Task Force, FTF, and OFAC is massive. We're looking at a guaranteed increase in pressure.
Not just rhetoric, I assume?
No, actual legislation targeting unhosted or self-custodied wallets. If a nation-state can use Bitcoin without KYC-ML rails to fund arms deals, regulators will argue that self-custody is now a direct vector for weapons proliferation.
So that means aggressive crackdowns on mixers, privacy protocols.
And a severe increase in censorship risk for stablecoin issuers if their assets are found to facilitate these transfers.
So the regulatory hammer we've always feared might be dropped not because of retail crime, but because of high-level statecraft.
Precisely. The concept of risk is being redefined from consumer protection to national security.
Okay, let's pivot to a contrasting approach. If Iran represents the defensive, sanction-evading deployment, El Salvador is demonstrating an aggressive, offensive economic strategy in the Western Hemisphere.
Their strategy for 2026, which kicked off on January 1st, is incredibly insightful.
Right.
They have officially integrated Bitcoin accumulation with artificial intelligence infrastructure development as the dual pillars of national policy. It's a genuine policy synergy.
Tell us what that synergy looks like on the ground. The briefing confirms their treasury holds, 7,517 BTC?
Yeah, which places them in a really high rank globally for national holdings. They are essentially turning their energy surplus into a computational engine.
Using their geothermal assets.
Exactly. They use that reliable, clean power to simultaneously power both Bitcoin hash rate, which maintains their accumulation and high-performance compute for AI training.
And they're creating these AI special zones with tax-free incentives.
They're trying to position themselves as a sovereign data haven, betting that the energy and cooling demands of the exploding AI sector will force tech giants to move compute to them.
That makes perfect economic sense. They are monetizing stranded energy into two forms of hard currency: Bitcoin and future AI compute revenue.
It's a clever use of geography and policy. However, the briefing also highlighted a necessary political maneuver.
Which was?
They relaxed the mandatory Bitcoin acceptance requirement to volunteer.
Was that purely a political move?
Absolutely. It was a pragmatic measure designed to appease the International Monetary Fund and secure a critical, pending $1.4 billion loan facility. It shows they're capable of blending their crypto idealism with, the financial realpolitik necessary to secure traditional funding.
A sign of maturity, really.
It is.
And we see this trend of state-sponsored monetization even in closed economies. Turkmenistan, for example, legalized crypto mining and exchanges on January 1st.
And that just reinforces the idea that Bitcoin is now viewed as an infrastructural mechanism for state commerce. Turkmenistan has massive natural gas reserves.
So this is about monetizing stranded energy.
Exactly. Gas that might otherwise be flared or unused is now being turned directly into hard currency, Bitcoin, under a strict state licensing regime. It bypasses the need for complex, often sanctioned banking infrastructure.
Okay, let's pivot now from nation-state strategic deployment to corporate strategy, which is providing a major structural floor to the market. And that brings us to the Tether floor.
Tether has evolved so far past its role as a simple stablecoin issuer. They've cemented their status as a systemic pillar, operating much like a corporate central bank.
And they just confirmed a big buy.
They confirmed the systematic acquisition of exactly 8,888 BTC in Q4 2025.
That specific number, 8,888, it often appears in their reporting. Is that truly programmatic, or is it more symbolic?
It's programmatic. It signals a dedication to a systematic accumulation strategy. This latest buy brings their total holdings to over 96,185 BTC.
Wow. Valued well over $8.4 billion. That makes them, what, the fifth largest corporate holder?
Arguably, yes. Their strategy is essentially a corporate sovereign wealth fund.
How does that wealth fund work specifically?
They're leveraging the high interest rate environment. They divert 15% of their net operating profits, which are primarily generated from the yield they earn on their massive portfolio of U.S. Treasury bills, directly into Bitcoin.
So this isn't speculative buying, it's a yield conversion strategy.
That's right. They're converting fiat-denominated cash flow into hard asset scarcity.
So as long as the USDT market cap continues to grow, and as long as interest rates remain high, Tether is a guaranteed price-insensitive buyer.
Exactly. This is a robust bid, independent of retail sentiment, or even the day-to-day ETF flows. That's what creates the floor.
A structural safety net for Bitcoin.
And they're using pure operating profit, which is exceptionally robust. Contrast this with other corporate buyers who might utilize debt or corporate treasuries that require liquidity for operations.
Speaking of corporate strategy, the mining industry is undergoing a huge strategic retreat and pivot toward AI. It feels like a trade-off of risk for revenue stability.
The Bitfarms divestiture is the clear signal of this trend. They executed a complete exit from Latin America, selling their Paso Pe, Paraguay facility for up to $30 million.
Why abandon low power costs in Paraguay? Historically, that was the primary competitive advantage for miners.
It's the AI premium pivot. Miners are realizing that while power is cheaper in Latin America, the geopolitical security and the revenue potential for high-performance computing, or HPC, hosting in North America are vastly superior.
So Bitcoin mining revenue is volatile.
It's tied to the hash price. HPC and AI hosting offers long-term, high-margin, stable, contracted revenue, often 3 to 5 times what pure Bitcoin mining yields on the same power capacity.
So they are sacrificing minor operational cost savings for huge security gains and access to higher valuation multiples from the AI sector. It's a sophisticated risk mitigation strategy.
Absolutely. They are mitigating jurisdiction risk and replacing the volatility of the Bitcoin price with the structural revenue demand of data centers. They're evolving from commodity producers into digital infrastructure providers.
Let's move to the market intelligence, because despite these huge structural shifts at the state and corporate level, the immediate price action is characterized by what the briefing calls compressed indecision.
That's the perfect description. You have this enormous accumulation happening structurally, yet the immediate market sentiment remains neutral.
We saw a resolute defense of the $87,000 support zone.
We did, which is encouraging, but we also saw a strong failed attempt to reclaim the psychological resistance level at $90,000.
The document highlights the primary tactical battleground as the 21-day moving average, which is sitting right near $89,500. For our listener, why is the 21 DMA specifically the line in the sand for institutions?
Because the 21 DMA is widely used by systematic funds as the benchmark for short-term trend health. If Bitcoin closes a sustained daily candle above that line, it signals to those quantitative funds that the short-term uptrend is intact.
And they can scale back in toward $100,000.
Right. Failure to clear it means the short-term bias remains neutral to bearish, and institutional de-risking continues. It's a self-fulfilling prophecy of institutional flow.
And we have to discuss the liquidity strain coming from the traditional finance side, the U.S. spot Bitcoin ETFs. The outflows were brutal in November and December.
They were neutralizing. We saw record outflows totaling $4.57 billion in the final 2 months of 2025.
Including a significant $348.1 million on December 31st alone.
That confirms what many suspected. Massive tax loss harvesting and general de-risking by traditional finance allocators who entered during the speculative Q4 highs. They are washing out the tourist capital.
But the key divergence noted is that this capital isn't necessarily fleeing the ecosystem entirely.
Correct. The liquidity is rotating internally. While the Bitcoin ETFs bleed, altcoin ETFs, specifically those tracking SOL and XRP and corporate treasuries like Tether, are actively buying.
So the overall ecosystem liquidity is stabilizing, but the capital is just moving around.
Exactly. Seeking better short-term returns or those structural safety nets we talked about.
I do need to bring up the elephant in the room regarding the downside risk, specifically the bearish pennant technical pattern that a minority of analysts are tracking.
Risk managers cannot ignore it, even if it is a minority view. Technical analysts argue that if we fail to reclaim the $92,000 level decisively, the existing price structure forms a classic bearish pennant continuation pattern.
And the measured move target from that pattern suggests a potential retracement to
$50,000.
$50,000 is a serious drawdown from these levels. Is there a scenario where it goes even lower, as suggested in the briefing?
Only in a worst-case scenario where the macro environment seriously deteriorates, say, a sudden, deep global recession that forces mass liquidation of all risk assets.
Okay.
In that technical model, the ultimate downside target could mathematically extend to $25,000. It is a tail risk, but it highlights the volatility inherent in this period. The market is structurally strong, but tactically vulnerable.
Let's shift gears one last time and talk about security and infrastructure, because the start of 2026 has been marked by the industrialization of sophisticated exploits.
The EVM wallet drainer campaign is particularly insidious because of its longevity and subtlety.
This is the one alerted by ZachXDT.
That's right. An ongoing campaign targeting hundreds of wallets across major EVM chains, Ethereum, Base, Binance Smart Chain, and the root cause remains completely unknown.
The method used, salami slicing, is designed for maximum evasion. How does that work in practice?
So instead of hitting one wallet for $1 million, which triggers immediate high-priority alerts, they are siphoning small amounts, typically under $2,000, from hundreds of different wallets every hour.
To fly under the radar.
Exactly. It's designed to fly under the radar of both victim monitoring and automated security systems. The running theory is a compromised browser extension, or maybe a widely integrated, low-use dApp permission.
And on the centralized side, we saw the brazen manipulation of the illiquid Barak Glide token on Binance.
This was a critical internal security failure. A compromised market maker account on Binance was used to pump the Broccoli token over 1,200%, by aggressively manipulating the order books.
That just exposes how vulnerable centralized exchanges remain to internal security breaches.
It does. What's truly remarkable is that a sophisticated external trader detected the security failure and managed to profit by shorting the anomaly, netting over $1 million.
They profited from the exchange's internal breakdown.
Yes.
On a positive note, infrastructure is maturing via consolidation and compliance. We saw a major M&A activity with the OSL and Banksa acquisition.
This is a signal that compliance costs are driving industry structure. OSL Group, a major Hong Kong licensed platform, acquired Banksa, which is a key fiat-to-crypto on-ramp globally.
Creating a vertically integrated giant.
With over 40 licenses worldwide, it shows that single vertical, smaller players are being forced out by the immense cost and complexity of global regulatory licensing.
We also saw a significant innovation in the stablecoin market, with Telcoin launching USD.
This is a major structural bridge between traditional finance and crypto. The EUSD stablecoin is issued by a bank-chartered entity in Nebraska.
So this is one of the first genuinely bank-issued regulated stablecoins in the U.S.
That's right, and this directly addresses the potential regulatory fallout from the Mindex situation we discussed earlier. If OFAC cracks down hard on offshore stablecoin issuers, having a legitimate bank-regulated onshore alternative becomes immensely valuable for institutional players.
Let's quickly touch on the Layer 1 utility shift. Solana's real-world asset ecosystem is surging.
Yes, Solana's RWA ecosystem hit a record $873 million in total value locked. This is driven by the tokenization of assets like U.S. Treasuries and fractionalized stocks.
Challenging Ethereum in a domain ETH long dominated.
It validates Solana's focus on high throughput and low costs, making it a viable and perhaps preferable rail for institutional tokenized securities that demand speed.
And SUI is aggressively positioning itself for the global payments vertical.
Their key innovation for 2026 is a game changer for user experience. Stablecoin transfers on SUI will become gas-free.
Gas-free.
Removing the friction point of needing a native token, or gas, just to move money, positions them as a direct competitor to traditional payment rails like Visa or MasterCard for global micropayment adoption.
So what does this all mean when you pull back?
What's fascinating here is that the market is no longer defined by if crypto succeeds, but who controls the infrastructure now that has gone sovereign and industrial. The easy money phase is definitively over. We are firmly in a phase of strategic deployment.
Where value accrues to those who control the physical infrastructure?
The energy, the specialized compute chips, and the compliance rails. For you, the key takeaways are the rapid geopolitical maturity shown by Iran and El Salvador, the structural safety net provided by the tether floor, and the absolute necessity of recognizing the rising security premium due to these industrial-scale exploits.
Here's where it gets really interesting. If the consequence of nation-states like Iran using crypto for defense is an aggressive crackdown targeting unhosted wallets and privacy protocols by Western regulators, does the pursuit of true sovereign self-custody, the fundamental ideal of crypto, inherently become a risk manager's nightmare in 2026? It raises an important question.